Welcome back to Talk Tickers. Sometimes a company drops an earnings report and the market just goes wild. That's exactly what happened with Napco Security. Their stock popped over 11% in one day. So what on earth did they say to get investors that fired up? Let's break it down. All right, here's the game plan. We'll start with the impressive quarter and why the market reacted so strongly. Then we'll dig into the numbers, the beats, the margins, and the real secret sauce here, their recurring revenue engine. After that, we'll look at what management's signaling for the future, which leads us to our own rating on the stock. And we'll wrap it all up with a trade idea. Sound good? Let's get into it. So, let's set the scene. February 2nd, Napco drops its Q2 results. And the market? Well, it didn't just listen, it screamed its approval. The reaction was immediate, it was decisive, and it was very positive.
And here's what that signal looked like, an 11.2% jump in one day. And get this, it happened on more than double the average trading volume. Now, for anyone who watches the market, you know that's not just noise. A big price move on huge volume like that is some serious high-conviction buying. It tells you the big players are stepping in. So the question is, what numbers did they see that made them so confident? Let's find out.
All right, let's unpack those headline numbers, because at the end of the day, it all starts here. Napco didn't just meet expectations, they blew past them on both the top and bottom lines. It was a really clean beat. Let's start with the bottom line, the profits. We're talking GAAP earnings per share here. The number came in at 38 cents. Now, Wall Street analysts, they were penciling in just 32 cents. That's a huge beat. A surprise of that size is exactly the kind of thing that makes investors sit up and pay very close attention. And it wasn't just about the earnings beat, it was how they did it. Profitability was a massive part of the story. Their overall gross margin hit 58.6%. Now that's up from 57% a year ago. That might not sound like a giant leap, but in the world of business, it's huge. It means the company isn't just selling more stuff, they're making more money on everything they sell. That's the name of the game, profitable growth. Okay, this table really puts it all into perspective. Look at the top line. Revenue grew a very healthy 12% year over year. Nice, right? But now look at the bottom line. Earnings per share, or EPS, exploded by almost 36%. So what does that tell us? It's something called operating leverage. It's when your profits grow way, way faster than your sales. It's a beautiful thing. It means the business is becoming a more efficient money-making machine. And that's fantastic. But the real story, the why behind this, is even more interesting. And that brings us to the secret weapon, Napco's recurring revenue engine. See, this wasn't just a one-off good quarter. We're talking about a high-quality beat, and it's all because the company is shifting its entire business model. They're becoming a recurring revenue powerhouse. Now, this chart right here is everything. It's the whole story in one picture. On the left, you have the gross margin on the recurring services, a jaw-dropping 90.2%. I mean, wow. Now look at the bar on the right. That's the margin on their old-school hardware sales, sitting around 28%. The difference is just, it's night and day. This super profitable service revenue isn't just part of the business. It's the engine driving the entire train. And you better believe management was hammering this point home on their earnings call. They basically put up a giant flashing sign pointing to this number, a nearly $100 million annual run rate for recurring revenue. The message is crystal clear. Hey, investors, stop thinking of us as some boring hardware company. Start thinking of us as a software as a service, or SaaS company. Predictable, high-margin, sticky revenue. That's the story they're telling. Which brings us to this idea of a recurring revenue compounder. What is that? Well, it's exactly what it sounds like. It's a business model that isn't chasing one-time, lumpy hardware sales. Instead, it's building a growing mountain of subscription revenue. It's predictable, it's high margin, and it just keeps compounding on itself, generating tons of cash. It's the holy grail for investors, and the market is finally starting to realize that's what Napco is becoming. Okay, so the numbers are great, the business model is shifting, it's all fantastic. But you also have to read between the lines. What is management doing? Their actions this quarter sent some pretty powerful signals about just how confident they are in the future. So, let's look at the clues. First, they hired a new chief revenue officer. You don't do that unless you're planning to step on the gas and accelerate sales growth. That's an offensive move. Then, they made a defensive move that shows incredible confidence. They raised the dividend by 7%. Companies only do that when they're absolutely certain the cash flow is going to be there to support it. So you've got them playing offense and defense. You add in their talk of continued double-digit growth and a rock-solid balance sheet with zero debt, and, well, that's a management team that's feeling pretty good about things.
So we've got the huge earnings beat, we've got the incredible recurring revenue engine, and we've got a super confident management team. Let's put it all together and talk about what this means for the stock going forward. It's time for the next call. So the big question is, after a quarter this good, where do we think the stock goes from here? What's our call? Our call is outperform, plain and simple. We believe the story here is not just good, it's getting even better. This quarter didn't just confirm the thesis, it strengthened it.
And just so we're all on the same page, when we say outperform, we mean we expect this stock to beat its relevant market benchmark, say a small cap index, over the next year. But look, a rating is just a rating. What really matters is whether the company delivers. So here's exactly what we're going to be looking for in the next report to see if our call is on track. Okay, time to put some numbers on it. For Q3, we need to see revenue growth stay in that 10 to 12% range. For earnings per share, we're targeting 40 to 42 cents. But honestly, the number I'm watching like a hawk is that recurring revenue run rate. It needs to cross that $100 million threshold. That's a huge psychological milestone for the market. If they hit that, and if those juicy margins keep expanding, then our outperform call is looking golden. All right, to wrap things up, let's have a little fun. We're going to pitch what we call a wild but plausible trade idea based on everything we've talked about. And of course, the important disclaimer will follow. So here's the idea. The thesis is simple. Even after that big jump, we think the market is still sleeping on how powerful this recurring revenue story is. The catalyst? We think the next 1 or 2 earnings reports will be the wake-up call. When they confirm that growth trajectory, you're going to see a wave of analyst upgrades pushing their price targets up towards $50. So how do you play it? The straightforward trade is to just buy the stock, NSAC, with a price target of $50 over the next year. Now, if you're feeling a bit more adventurous and understand the risks, you could look at call options to get some leverage on that move. And that brings us to our most important slide. Please remember to always do your own research before making any investment decisions. Nothing we've discussed here today is financial advice.